So this property inventory account is going to get higher and higher and higher the more money you put into it.
Okay.
Does that make sense?
Yeah.
And then when you sell the property, you have to remove the inventory because you can't carry the inventory on your books anymore. So you remove the inventory by crediting the inventory account, and the debit to offset that is property basis.
Okay.
So does that, I don't know if that helps you get a little closer on that.
Yeah.
A little more understanding.
Were you recording on your end or no?
Oh, I allowed you to record. Did you?
Yeah, I just realized.
I did not hit record.
Yeah, I just started recording, so I think I just missed all that recording. Bummer.
Oh, darn it.
Yeah, okay.
So, yeah, so that's how the property basis works.
So real quick, property basis is more or less any kind of acquisition cost or anything tied to the property when we purchase it?
Yes. So in the end, yes, you're thinking along the right lines, but there's a step in the middle we have to do first.
Okay.
Any acquisition cost, if you're paying legal fees, I don't know if you have to pay legal fees sometimes to get to get notary fees.
Yeah.
Anything like that, it is going to hit property basis in the end. You are exactly right. But first, we need to take a stop in the inventory account. We need to hit the inventory account first because let's say you buy a property in December. I don't know if you purchased any properties in December.
Mm-hmm.
You buy a property in December, let's say. It's going to sit on your books. Let's say you spent $15,000 in December to get the property. When you file your tax return, you're not allowed to expense any of those items. It all needs to hit. It needs to sit in your inventory. And then when you sell the properties, when we remove the inventory and expense all of those acquisition costs, everything through property basis.
Okay.
So it's maybe a little easier to understand with the actual documents and everything. I'm going to exit this. Actually, no. I'm going to go ahead and remove this journal entry. We don't want to sit this in there.
Right.
Get all messed up on you. And I'm going to go remove this guy as well. So I would say the important things you need to know for now are once you get your bank transactions kind of hooked back up, every single item needs to either go to an inventory account. So if it's a property, so this is a $500 withdrawal. I'm not sure what this exactly was for. Canvas CU.
Yeah, that was for.
If this is related to
contractors of some sort. Yeah, I think it was related to contractors of some sort on a property.
Which property do you know?
I think it was Elkhart. You just type that in.
Do we have that one?
No, we don't have that one. Yeah.
In here yet. So the point is, you do not put it to the contractor's expense account. You need to put it to the inventory account.
Okay.
So I can add that. Well, what's the street number on that one? Do you know?
5052 Elkhart, ELKHART.
Elkhart's one word. Elkhart?
Yes, sir. Yep. Street. Yep. You got it.
So we'll throw it in there. This is going to be another current asset.
And this is one we can leave because I know that this is from this.
Cool. So yeah, so this is exactly what we want to do. This purchase goes to this property.
Okay.
That's where we're going to do with it. That's what we need to know for now. Save that one. Let's find one on here that's kind of an overhead expense, possibly like Amazon for $50. Was this related to a specific property? Do you know?
Those were for the handles for Elkhart.
Okay, so yeah, so this one will go to the
Okay.
Elkhart property. Boom. Other one, so QuickBooks, this is a good one. QuickBooks, this is not for a property, right?
No.
So office supplies and software is an expense account. We don't want to put this one to inventory. This is one of the expenses that you will have an expense for.
Mm-hmm.
So office supplies and software, I like that one. Let's go ahead and hit add on that.
Okay.
So, and then Kohler here, 125. This looks like it was maybe a retainer or something. Legal and professional. This is another one that's not specific to a property. We're just going to hit it to this legal and professional services expense account.
Yeah.
Makes sense.
Okay.
Was there any in here? Where's that 18,000? So there's this 18,000 you thought was maybe for to to the public trustee.
Yeah, this 18,000. Yeah, I'm trying to remember exactly where this one went to. That was 16th. That one's for the public trustee, I think, for the Elkhart one, I think. Yep.
Cool. So this is another example. This one we're going to put to the 5052 Elkhart inventory account.
Okay.
And it's going to sit in inventory until you sell it.
Okay.
Once you sell it, we're going to credit the inventory to pull the property off the books. We're going to pull the inventory off, and you're going to debit the property basis expense account.
Okay.
When you sell the property.
That makes sense.
So yeah, so once you get this thing reconnected, you'll have all these transactions in here. You'll have to go through it. You have to hit every single one. You have to go through every single one of these.
Okay, and then like an owner's draw down there you see on 319. Yep. Is that correct?
So this was you put money in. This is $3,000 you put in.
Oh yeah, I guess it's not a withdrawal. Yeah, it's a contribution from me. Is that correct?
Yep. So your equity accounts are here. So you have a draw account, an earnings account. You pretty much won't ever touch the earnings. You need to worry about investment and draw. So
Okay.
if you're putting money in investment, let's say it was $3,000 going out to you, then it's draws.
Okay. So that's right.
So I'll go ahead.
Okay. Yep.
This 4,000 here, was this a third party lender or is this Bobby putting money in?
I don't know. It might have been money where he borrowed money and he put money back in. I don't know what that would be considered. Would that be considered a not a deposit, investment?
A loan, a liability?
Yeah. So if he borrows money against the against the business as like an owner's draw to repay it later, how would that look?
So this is money, he took money out, you're saying, and then put it back in?
Yep.
So there's two ways you can do it. There's kind of the way you're thinking of it, sounds like, as a loan to himself.
Yep.
And we could do a partner loan, or we could hit it. So this is him putting money back in, obviously. So I would want it to go to the owner's investment, just like you put $3,000 in. He put $4,000 in.
Okay.
And the $4,000 he took out should go against his draws account. This one.
Okay. Yeah.
So then the draws and the investments net against each other, and they zero itself out.
Okay. Yep.
So I'm going to throw it against the owner investment. So the $4,000 that he took out, I don't know if we can find it now, maybe not.
Yeah, I don't know.
Let's see if it's in here somewhere. No, I'm not seeing it.
Okay.
So yeah, once you get the bank reconnected, it'll work. Trying to find one maybe. So 15,000, Francis Gonzalez.
So this is a loan. This is a loan for, I think, the Elkhart property. Yep.
Cool.
Definitely.
So if you remember, what we're going to do here, we're going to create a liability for this one. So let's just call it Francis Gonzalez. We're going to make this thing their current liability here. Other current liabilities, and then we'll make this a sub-account of our notes payable, if you remember. So we're going to have Susan, and then we're going to have Francis as well.
Okay.
Just like that. And then, I don't know, what was this 5,000? You remember from 414?
I do. That was also the same thing. That was a loan.
From Francis or from someone else?
From someone else. That would be Sally. WOJCIK.
Okay.
No payable. Okay.
Okay. So we're going to add this one. Yeah, same exact thing. So we're going to make this. We're going to make it other current liability sub-account notes. So when Sally got paid back, did she get paid back from you directly, or did she get paid back out of escrow, out of title?
So Francisco and Sally both got paid at the end out of the escrow.
Okay. So then you'll remember when you record that closing statement will have those specific loan payoffs on it.
Okay.
And so to pay them off, you'll hit the liability account for 5,000 and then for 15,000, and then you'll put interest paid for whatever interest they got.
Okay.
That makes sense?
Yep.
Okay, so those are a few examples. Are there any more kind of examples you want to walk through as far as transactions as you're kind of thinking what you might run into?
I mean, at the very end, just reconciling all that is still a little bit confusing with what's the cost basis and what are expenses from the closing costs.
Right. Yeah. So another journal entry. So let's just say, did you sell that Elkhart property already?
Yeah, that one's kind of confusing. So we took it over subject to, held on to it, and then it got technically refinanced to my business partner's name, and then he ended up selling it later. So we still had lenders on the property under Helping Hands, but he sold it under his business later to another company.
Okay. And that was him personally that did that through?
Well, his own personal business that he has 100% ownership in, yeah.
Okay, yeah, that one's going to be a little complicated because we'll want to do some, that's going to go in and out of either some equity or some intercompany loans then is what we're going to have to do there. So he owns 50% of Helping Hands personally, right?
Correct.
And then he owns 100% of that other business personally.
Yeah, it's called home buyers. Yep, local home buyers. Yep.
Okay, so we would run that through his draws and investment account then. And yeah, we have to look at the specific details. So basically what's going to happen is when the title gets removed, we will want to, when you refi it, title shifts over to his entity, right?
That's correct.
So in that case, when that happens, we'll want to remove the liabilities to Sally, to Francisco, to all those other things. And so we'll basically want to record it then, and all of that is going to go through his draws account.
Okay.
That one's a little more complicated, a little more hands-on.
Yeah, it is.
With that one we probably need to have all the documents and everything and look at it specifically to show how to record it.
Okay.
In that case, so yeah.
Okay. Okay, so for this one right here, how would it look if we were just selling it to like an end buyer or whatever?
So yeah, let's assume it's that. Let's just say you sold it on like 09/30/20 or something.
Yeah.
So sales income. So we're gonna hit sales account. Whoops. Sales. How much do you want to sell? Let's say we sold. How much did it sell for?
We'll say like 250, I think.
Now, what are the closing costs typically you see on one of your closing statements? Commissions, probably?
Yeah, commissions, about 4% of whatever that is. So that would maybe be like, I don't know, 14,000?
10 grand?
Yeah, like 12 grand, something like that, yeah.
So we lump it all into what we call closing costs.
Oh, okay.
Some people will make a specific commissions account, but we put it all in the closing costs. So let's just say this is going to be our commissions.
Okay. Commissions and closing costs. Okay.
Yep. So I'm going to put in the description commissions.
Okay. Commission and CC or whatever.
What else do we have on a typical?
No, that would be paying off the lenders, I guess, right?
Lenders, yeah. So let's say that's what we're throwing. So with the lenders, it's a little interesting because you do not hold liability because you're doing subject to, and the whole point of subject to is you do not have liability, right?
Yeah.
The original homeowner continues to carry the mortgage. You make payments for them, but they're going to carry the mortgage.
Right.
So in that case, we're not going to pay off a liability because you're not carrying the liability at all. Mm-hmm. And so I guess that then we have to look at how we're treating the mortgage payments because you don't carry the mortgage, but you're making the payments, right?
Correct.
So all of those payments, we're going to hit those against some sort of expense account or some sort of clearing account. So let's just say it's a mortgage clearing is where you're hitting it there. But what we're going to do here is we're going to hit property basis. And let's say
180,000.
How many? 180. Okay, 180 is perfect.
Then
and then those will hit your P&L, and then the payments you've been making will be reversed against those.
Okay.
So, but for this purpose, all you have to do is hit your property basis for whatever that mortgage is going to be.
And then the payment would be like the monthly mortgage payment. That would essentially just go towards the inventory, right?
Yes.
Okay.
Exactly right. There is an issue though, because of the subject to, part of that payment that you're making is part principal and part interest, right?
Correct.
The rules with subject to is because you do not hold the mortgage, you are not allowed to deduct any mortgage interest.
That's okay.
So that'll come out. We'll just throw that on a separate item instead of throwing it in inventory. Yeah, but the interest, I mean, you're only holding it for 120 days, and so there's not a ton of interest being paid, right?
Right.
So, okay, so there's that one. And then let's say there's
Second.
Sally, so we're going to remove
yeah.
Sally's. And she was 5,000.
Yep.
And then what's the interest going to go to her? Do you think on this?
$500, I guess.
500. That was. And then we got Francisco.
Mm-hmm.
What's he doing here? And he was 15,000.
Yes. And he got like 1,500, I think. Interest paid. Okay.
So that's how that's going to go. And then anything else, if there was back to child support or anything on this one?
I don't think so. What about like a referral fee to a certain person who maybe found a deal or something? Maybe $3,000. How would that be paid out as?
Great, yeah, great question. So that's going to be that's on title, right? It's on the closing statement.
It would be on a closing statement, but they maybe never were actually on title. They're not part of our company. We're just kind of paying them for it.
Sure. So that one is going to be very similar to the commission, to the real estate commission. So we'll just hit closing costs.
Oh, okay.
And that's supposed to make sure this is a finder's fee or something like that. Yeah, that's a pretty common one we see on closing.
Here, let's just change it to like 3,000 or something. Yeah, there we go.
There we go.
Cool.
And then anything else on this HUD statement you think?
Like no, I don't think so. I guess if there was like maybe a second position mortgage, would that still just be the same as property basis?
Yeah, so it depends. If there's a second position mortgage, who was holding it? Did you ever hold it, or it was a second position that the buyer, or that the original homeowner was holding?
Well, in this instance, it was solar panel, so it was like a solar panel, like lien or like a payoff. So it was the original homeowner.
Sure.
Original homeowner.
So that will probably be, that'd probably be a cash out. Yeah. So when you purchase the property, even though you're doing subject to, you would want to pick up the liability on the solar panels then, unless you're not doing that with your subject to agreement. I don't know. Are you picking it up?
No, but when we sold it, when we refinanced it at the 250, that solar panel lien was paid for, I believe.
Okay. Yeah. So then that will be similar then to the homeowner mortgage, since you never picked up the liability.
Okay.
So that'll hit your property basis as well.
Okay.
Did you make payments on the solar panels for them?
No. That was we didn't even know it was behind like 6 years.
Oh wow. Did the solar panels still work?
Yep, they still worked. He thought it was the original homeowner thought he was getting it for free. Yeah, crazy.
Yeah, there you go. Yeah, so you'll just hit the property basis again. For how much was that? Like 16, you said?
Yeah, something like that. And then if there was some type of second position mortgage, same thing. It would still be property basis.
Same exact thing.
Got it.
Since, yes, unless you were somehow picked up that mortgage, which it sounds like you're not doing because you're doing all subject to.
Yep.
So, yeah.
Okay.
All right, so there's that. So then the difference here, we do have a difference, and that's going to be the cash due to, that's going to be the cash due to you guys. So in this case, it's $15,000 of cash due to you.
Okay, cool. And
but I don't want to put, I want to put solar here and then cash due to seller.
And then
Sorry, I didn't mean to cut you off. What were you going to say?
Oh, I was going to say like line number like 6 and 7, the ones that's, yeah. What in description, what would that be?
Yeah, sorry. It carries commissions.
Yeah, I know.
Carried that all down here. Sorry.
Yeah, it's okay.
So this one is going to be. So this is going to be mortgage payoff or something.
Sure.
Homeowner or something like that. This one is payoff, or so let's just say salary. Whoops. And then we could say here something like that. And then same thing with France.
Okay. Okay.
Like that.
Okay. Yep.
So then I heard put like solar. Okay. So, but then we got our other important step. If you remember, we have to record the property basis for the actual what you paid the county trustee, and what you paid the homeowner to get the property.
Yes.
So you remember we already recorded those transactions, a month or 2, 3 months ago, and where are they all sitting right now?
In the inventory.
Inventory, exactly right. So we're gonna go to the L cart here, and let's just say I can't remember what it was.
It's 18,000, I think, or whatever, something like that. Yeah.
Something like that, yeah. And then you're also going to add to that, obviously, any utilities you pay on the property, any property taxes that you pay them, any other, repairs and stuff like that, all goes to that inventory account. So then again, our property basis is 18,000.
Oh, I see. Okay, so inventory 52 L cart, that's going to have all of the info of all the things that we already paid, and it'll just have it as just one line item, more or less.
Exactly right. Yeah. So we're gonna pick it all up at once at the end when you sell it and remove it at once.
Oh, okay. That makes a lot more sense. Okay.
So, and then this is obviously, this is remove property, and then this is our cost of goods sold, essentially, property basis.
Okay.
That makes sense?
Yeah.
So, yeah, and that's how you're going to do it. If there's any other things you need to remove, there shouldn't be. Everything should hit this inventory account. If you pay for anything, if you pay to get the lawn mowed, if you pay, obviously, everything we've talked about, that needs to hit that inventory account.
Cool. Okay. And then one last question do you got anything else on this? Sorry.
As far as this journal entry goes, I think that's kind of the basics of it. A lot of it is going to be off the HUD statement, and then honestly, it's not too hard. All these things here that we've recorded are going to be on the closing statement. So really what you're doing is you're just kind of copying it into here and just making sure you hit the right account. And then you remove the property and then expense it off like that.
Okay.
That's all I had on that. So go ahead.
Okay. So when we do submit this for, after we've done our bookkeeping, we've reconciled all this. So we're going to need, obviously, our closing statements, our HUD statements. What else are we going to need? What other documents do we need to accompany each specific property's inventory?
If you have any, I would submit if you have any documents that show what you paid to the county trustee, public trustee.
Okay. Yep. Sure.
That's going to be a big one, kind of like the big dollar items, the big ticket items. That one, they're going to have good documentation on that. If you paid any property taxes, you should be able to get the property tax statements from the county. We'll want those. If you ever get issued a 1099-S for when you sell the property, some title companies do, some don't, we found. If they issue a 1099, so they would issue a 1099 essentially for this $250,000 up here. Well,
Okay.
This one was a refi, so it wouldn't be on this one, but on the ones that you actually sell, you'll have a $250,000, a 1099 for that. Like I said, sometimes they do, sometimes they don't. If you get one, send it to us.
Okay.
Other than that, nothing comes off the top of my head here. When you do submit everything, we can look at some stuff.
Okay.
And request specific things from you.
Yeah, and one last thing, to go back, you could delete this guy if you want this.
Yeah, I was just gonna exit and not save it.
Oh, okay, cool. I was going to say when we're recording that for the public trustee and the money that we give to the homeowner, that's my last question I have as a journal entry here for
No, that
inventory.
one. Or explain what you're asking a little more.
Yeah,
Sorry.
not a journal entry. Sorry, for a right here, like say one of these, any of these. Yeah, we're for where we spent money.
3,600.
Yeah, we'll just say we gave that to the homeowner for money for them to transfer over the property to us. How would that be recorded?
So yeah, so it's the same exact thing as we've been doing before. It's just like you're doing to the title company. So say this 3,600 you paid to the owner of the Elkhart.
Sure.
You just sent the inventory account just like that.
Okay. And then
and
would
then
we
I
just?
I would add in the memo, money paid to homeowner or something like that. Yeah.
Okay. And then tags. What is tags? Is that relevant?
So tags is kind of new to QuickBooks Online. You can tag it, so kind of think about what's important to your transactions. Tags don't affect your books, so you can use them however you want. It's basically, if you wanted to tag this as the Elkhart, maybe you did a bunch of plumbing, or maybe this was maybe landscaping or something. You could tag it if you wanted. It's not required. It's not a huge deal. We typically don't use them. It's more for the specific owner of the business. If they want to tag certain items, like I'm going to tag everything that was for X employee. If the expense was related to X employee, I'm going to tag it with his employee number.
Oh,
or I'm
okay.
going to tag it,
or if it was
something like that.
Or if it was something relating to like flooring, like we did carpet, vinyl, tile, like that, flooring.
Sure, yeah. And then you can run specific reports to say, yeah, at the end of the project, I spent X on flooring because you've tagged all the flooring.
Okay, so if I was going to do that, would I just do like I guess the name of the property, like Elkhart, and then flooring, like a tag like that? It could be anything I want, like that.
Sure. Yeah. Sure.
Okay, and then so the same thing. If say that this $3,600 was money to go towards the public trustee, it would just still be inventory, but we just change the memo towards public trustee, right?
Correct.
Cool, man. I think I got it.
Everything hits inventory with fix and flips. So.
Okay.
So yeah.
Sweet. I think that really answers all my questions here. Unless you got anything else, man. I think you really brought it all together for me, man. I can't thank you enough. That's huge.
Absolutely. If you have any questions in the meantime, feel free to email me. If it requires anything, like we jump on a phone call or anything, I'll let you know up front. Like, yeah, we built this straightforward. But if you just have a quick question on a transaction, just shoot me an email and I'll respond to you.
Okay.
And you don't have to worry about getting charged or anything on that.